If you're a subcontractor in New Zealand, you're all too familiar with retention money. But are you up to speed on the massive new law that's designed to make sure that cash is actually safe? Let's get right into it, because understanding these changes could be the difference between getting paid in full and getting nothing. So you've done the hard work, you've put in the long hours, and then a chunk of your pay gets held back. For years, that money was basically sitting on a prayer. If the main contractor went belly up, your retention money could just disappear. Well, we're here to tell you how that whole game has fundamentally changed. The real catalyst for all this, you might remember the name Ebert Construction. Their collapse back in 2018 was a huge wake-up call for the entire industry. It ripped the cover off a massive flaw in the old system. See, the old law was supposed to protect your money, but it just didn't work. When Ebert went down, heaps of subbies found out their retention funds were just mixed in with the company's general cash, and it was all gone. That disaster led us directly here to the Construction Contracts Amendment Act 2023. And let me be clear, this isn't some minor adjustment. It's a whole new shield built specifically to stop another Ebert situation from ever happening again. Okay, the absolute heart of this new law is something called a deemed trust. What does that mean? It means the second a main contractor holds back even $1 from your payment, that money is automatically by law considered to be held in trust for you. They don't have to do anything. No forms, no special accounts, it just happens. It is officially no longer their money to play with. This one change slams the door shut on that massive old loophole. Your retention money can't be used to pay the power bill or cover payroll anymore. By making it trust property from day one, the law basically puts an electric fence around your cash. So if the company goes under, liquidators can't just grab it to pay off other creditors. So a trust sounds pretty good, but what does that actually look like in the real world? The law gets super specific about how your money has to be secured. There are only two legal ways a main contractor can handle this. Number one, they can put the actual cash into a separate bank account that's only used for retentions. That's it. Or number two, they can get a financial instrument. Think of it like an insurance policy or a bank guarantee that promises to pay you if they can't. So let's break that down. On one hand, you've got your actual cash sitting safe in a bank account that the bank knows is a trust account. On the other hand, you've got a guarantee from a big financial player like an insurer that says you're covered no matter what. In the end, the result is the same. Your money is meant to be secure. The main thing to remember is it doesn't really matter which method they choose. The whole point is to create that protective barrier around your money. It's ring-fenced, so it can only be used for what it's for, paying you or fixing any defects that might pop up. Okay, this all sounds good in theory, right? But how do you know it's actually happening? Well, this is the other game-changing part of the new law. You now have a legal right to get proof. The law has a really clear timeline. The main contractor has to send you a report pretty much as soon as they withhold your money for the very first time. And after that, they are legally required to give you an update at least once every 3 months. This isn't a nice to have, it's mandatory. And these reports can't just be a quick email. They have to include some very specific details. We're talking the exact amount of money being held for you, the bank and account number where it is, or if it's a bond, who the issuer is, and the policy number. And here's a big one. The report must also state that you have the right to inspect their records. That transparency is a whole new world. So, what happens if a company or its directors just decide to ignore these rules? Well, this new law has some serious teeth. We're talking about major financial penalties for the first time. For the company itself, failing to secure retention money properly is a huge deal. The fine can be up to $200,000. And that's not just a one-off hit, it's for each offense. But here's where it gets really personal. For the first time, company directors can be held personally liable. We're talking a fine of up to $50,000 for each offense that comes directly out of their own pocket. Now, that is a serious incentive to do the right thing. And you have to understand, these fines stack up. If a director fails to protect money for 10 different subbies, that's not one mistake. That's 10 separate offenses. You do the math. That's a potential $500,000 personal bill. The risk for directors who don't comply is absolutely massive. Now, it doesn't stop there. There are other big fines too. Failing to keep the right accounting records, that's a fine. Not sending out those reports every 3 months, that's a fine. And intentionally giving you false or misleading information, you guessed it, another fine of up to $50,000. Okay, we have covered a lot of ground. The problem, the solution, and the serious penalties. So, let's wrap it all up with a simple checklist you can use to make sure you're protected. Here's your game plan. First, expect to see that report as soon as money is withheld. Second, make sure you're getting a detailed update every 3 months. If a report is late or looks a bit thin on details, don't just let it slide. Ask questions. Remember, the law is on your side now, and the directors are personally on the hook. And if you're really worried, you can take your concerns straight to MBE. Look, what this all comes down to is that this new law gives you power and transparency like never before. You no longer have to just cross your fingers and hope your retention money is safe. You have the legal right to verify it. So the only question left is, are you going to use that power?
If you find this episode useful, please remember to like, comment, and subscribe. Thank you so much for watching. See you next time. Bye.